Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is November 30th, 2023, and we're going to discuss, does pending home sales mean a pending recession? We'll start with just the real estate chart. This is a real estate chart. It's a sector ETF, and it's attempting to track the overall real estate sector or real estate market. And as you can see, we had bearishness since really the beginning of the year, February all the way down. We've continued lower until we found the lowest point about a month ago, October 30th. We've rallied and created higher highs, higher lows, higher highs, higher lows through here. And if you watched at the close, you know that one of the trades I was looking at was a bullish trade in Annaly. And it's a mortgage REIT, but still, the idea that would be supporting higher levels of sales and the higher numbers that we'd expect to see in real estate because we saw bonds rally and yields fall. So as we're looking at this, it would seem that we're in a fairly bullish situation after recovering well off the lows and heading towards the highs. Is that all the information we have? Let's take a look at the pending home sales that came out today. Pending home sales is a report that comes from the National Association of Realtors, and you can see right through here. I like to generally use the charts here, but it's not telling us enough of the story. So if I click on the charts, you'll see, yeah, we came in at negative 1.5, but that was better than what we expected. We've been a lot worse. We've been negative 10%. There's only negative 1.5. Even if we adjust the revisions, we can see that the revisions, yes, they've been negative most of the time, and overall, though, this is not outside of normal. So it seems. But it's this grouping of all of the sales that we need to take into consideration. When we look at all of that data and we look at the numbers that are associated with that, we're not looking at just what it did from one month to the next, but really what we're looking for is we're looking for the overall sentiment in looking at the total data and kind of calculate, including the 2020 lows, and the connection with all of these lows, and not just look month over month, but let's go year over year, and let's look back at the last decade. Going directly to the National Association of Realtors and just looking at the report, pending home sales, a forward-looking indicator of home sales based on contract signings, dropped 1.5% to 71.4% in October. This is the lowest number since the index was originated in 2001. So what this is telling us is this is the lowest number of houses basically under contract that are pending closing. It's the lowest number since 2001. That includes 2008. That includes 2009. So as we peaked out in the market and we've sold off, that means we have less sales going on of pending home sales than we have since this was created. This has a tendency, pending home sales has a tendency to lead existing home sales by approximately 2 months. And so we expect these numbers, the last couple of months negative from pending home sales, to continue to feed into existing home sales. If we look at existing home sales are already down 4%. So if we see another slip of 1.5% and see a multi-decade low, 22-year low, all the way back to the beginning of that pending home sales, then we're facing the lowest numbers likely in existing home sales, just like we have in pending home sales. Now I'm going to borrow from Y charts here on U.S. pending home sales because you can see the number that we just reported in, 71.4. That's matching to the history. And as you can see, it's just set to the 1 year. It's the lowest level in 1 year. Let's go to max because this pending home sales number, you can see the lowest number we had back here during the COVID lockdown and the pending home sales then was, it says it was 70, but according to the Realtors Association, this is the lowest number we've ever had. And now, why would pending home sales go lower? Why would existing home sales go lower? There's two reasons. One is either we have no supply to sell or we have no demand. If there's no supply and no demand, if there's no money, homes being put on the market, doesn't mean that there's not homes being built. It doesn't mean there's not other things going on. But the fact is there's no homes to sell. Then we can't have rising pending home sales or existing home sales. But then we'd have a lot of demand. You should see a lot of new construction. We're not really seeing that. And again, knowing that existing home sales lags pending home sales by about 2 months, then these numbers pushing down to the lowest levels, and I know we can't go back far enough on this chart, and the National Association of Realtors doesn't have a very clean graphic as far as graphing history. Maybe I'll have to build a new chart for next time. But we can expect that existing home sales are going to lag and continue to slide. We already saw it drop 4%. What does that mean to home builders? if existing home sales are lagging and sliding and dropping, and we're already at a record low for pending home sales, are we going to see a record low for existing home sales? If we're going to see a record low from existing home sales, are we going to see an end to the new home construction demand and see new home builders fade? So let's take a closer look by going into home builders. Starting out here with home builders, you can see home builders have held. ITB is my preferred one over XHB. I like ITB a little bit better. But as we're looking at this, you can see that we are near a short-term resistance. Now, this arguably was overbought. And the reason why I say this is arguably overbought is we had these highs and these lows, and when we did break out of that double top, triple top, whatever you want to call it, that rectangle, the rectangle's high became resistance, and we're back at that resistance. We're not only back at that resistance, we created a bearish divergence, bearish divergence, bearish divergence at that resistance. And so what would cause ITB to roll over? Well, if there's no demand. So if pending home sales is lower because people aren't buying, then existing home sales will continue to slide and impact to new home construction. So new home construction is going to struggle up here, likely not be able to clear the highs, and there could be a really good opportunity to short or at least sell premium on something like ITB or XHB, or maybe the specifics, including the DR Hortons, Pulte, Toll Brothers, KB Homes, etc. So what is the catalyst that will keep us away from that? What is the catalyst that will make it so that we don't see home builders sell off and retest 70, that we don't see a $15, $16 drop, 20% move lower in home builders? Well, it's really going to come down, in my mind, to whether the economy can stay resilient, whether we can see the employment stay high, and whether bond prices return to moving higher, which means lower interest rates, or if today is the rollover where we see a significant rollover, a big candle, lower highs, lower lows, are we going to see bonds fall and yields go back up? Because if yields are going back up, if yields are going to return back up to that 5% or higher, then that 5% or higher move in yields, if we return back up here, then we will see demand likely get crushed. If we continue lower, then demand is going to return. And here we are at this inflection point, previous highs, consolidation, previous lows, bouncing, with the bullish divergence here. Either we're going to go higher and retest 5, or we're going to break free and go from 4.2 down to 3.5 or 3.6, somewhere in here. If we return back to the levels of March, April, May, then demand's going to return. We're going to see new construction begin. We will likely see a ton of sales of properties in the first quarter and second quarter of next year, and we'll be fine, theoretically. But if prices go higher, then that's a problem. And if prices go lower, that's an extra boon, not just to existing home sales, but to refinances. And if refinances happen, then we know that people will spend money that they don't have. They will spend money by paying off their credit cards with the refinancing of their home at lower rates in the 3s, 4s, and 5s rather than the 5s, 6s, 7s, and even 8s. It all comes down to 10-year Treasury yields and 7-year, but also how those pending home sales are telling us whether the demand is there at these levels. So last month when we were up here, it slipped. Last month when we were up here, we went to a 20-year low, while we were also near a 20-year high in interest rates. Now, this is not the highest level we go. We actually have to go back to that 2001 time frame. So we theoretically could be all the way up here, but we were near a 20-year high as far as yields. So if yields get up through that 5%, and certainly if they get up to 6 or 7, this will be the destruction of demand for housing, new mortgages, etc. People will not be refinancing their home, will not be pulling equity out of their home, will not be paying off their credit cards, which means they are going to be leveraged out. We've already seen the credit card companies leveraged out. So we're at this inflection point, and we're reading that with the pending home sales, which is one of the earliest indicators that we can use in the real estate market, which is the #1 asset that the consumer has. In the meantime, if we go look at Visa as our indication of how consumers are spending, we are still spending. This does not indicate debt or no debt. It indicates transactions. So we see that we're pushing up to the annual highs all the way up through here. Yes, we're still creating bearish divergences. Yes, we're putting some pressure on way up here at the top, but this is a new annual high for Visa. My canary in the coal mine is healthy and singing all the way up here at the top. Where do we see it break free? Well, if we're going to see it break free, either we're going to see, again, yields stay low and more spending push Visa higher and the home builders, or we reverse as we did today and we return to higher interest rates, which would put the top in Visa as well. Now, if I jump over for just a minute and look at the individual new home construction companies, let's just take a look at their fundamentals and determine which one we might be more interested in trading. So let's go into the analyze, and we will start with Toll Brothers. Has to sell inventory to be able to be okay, but they have a current ratio of 3 if they don't have to worry about selling inventory. If you don't take inventory out, they're sitting on a lot of inventory, a lot of houses right now, but they have a 0.53. So the quick ratio is 0.53, and normally I'd say that's a bad news. For a home builder, it is not as bad as we would expect on a brick and mortar type company. If you look at the quick ratio on DR Horton, it's 0.4, so it's even worse than Toll Brothers. If we look at something like Pulte Homes has a little bit better quick ratio and a much better current ratio. And we can look at KBH, and KBH has the best quick ratio and best current ratio. So we might be looking at this and saying, look, they don't necessarily have as high of a net profit margin. Year over year, it's been rising, and they have the better of the current ratio and quick ratio, so they can manage a drawdown a little bit better without having to liquidate the assets as much. And we can check Lennar. So Lennar actually is destroying all the others as far as quick ratio and current ratio. So they have the ability 3 times, even if you take assets out, which would include built homes and waiting homes, they win. So they're a home builder as well. And if we're going to buy one, we might buy Lennar and we might sell DR Horton. Now we could put the two together into a pairs trade, but right now it'd be buy this one, sell the other. And regardless of how the market goes, I'd be looking at selling the top in DR Horton and maybe Toll Brothers and buying Lennar. In fact, they're pretty close to the same price. So we could take LEN and minus out DHI, and this would be a pairs trade with the expectation that we would be buying Lennar and looking for this to go from 27 up to 750 up to 10. You're buying the one, selling the other, and playing the moves in between. Now, that's not the margin that it would take, but it's certainly the return that you might be able to see off of buying the one and selling the other. Could be 10 times as far as this goes. But the nice thing is it's a hedge because you're not expecting a significant move when you're buying the one and selling the other. But I do like Lennar. That was one that I wasn't originally looking at, but I'm liking it a lot more. They have the money, they have the flexibility, they have the best current ratio and quick ratio of all the home builders. And it might be the one to buy, and DR Horton might be the one to sell. One more thing we're going to look at is DR Horton compared to the 10-year Treasury yield and Lennar compared to the 10-year Treasury yield. Normally, we expect it to be highly inverted as far as the correlation, meaning if the rates are going up, that should hurt the sales of new homes. If the rates are going down, that should benefit. So we have to zoom in on this and make sure it's set to 1 and -1. And if we look at the comparison, the correlation, normally we have a very high inverse correlation. So looking through here, just the last year with DR Horton, and you can see that just recently we're at the 97% inverse correlation. We've decoupled, which has happened a couple times throughout the year, but the majority of the year we have an inverse correlation. And as we're watching the yields pull back really quickly, that would normally mean push DR Horton through the roof. This did not happen. So as it gets back into positive correlation, if yields go higher, then this should come down. If yields go lower, this should go up. And when it goes inverse and the 10-year Treasury yields move off of this current support level, whether lower or higher, then trade accordingly. If yields go higher and the correlation gets inverse again, then expect to sell premiums, sell calls, sell call verticals, or buy long puts, expecting it to come back down possibly all the way to 100 and looking for 20, 25, 30% drop. And if we expect rates to go lower, if bond prices go higher and rates go lower, then a company like Lennar, who will also have an inverse correlation, same correlation being decoupled temporarily, but as the correlation becomes inverse again and yields go down, expect Lennar to go up. Well, that's going to do it for me today. Have a fantastic day. We'll look forward to talking to you again next week.